And welcome back live to WomenMoneyEmpowered.com. I'm Kathy DeWitt. Thank you so much for joining our show today. Bruce, it's great to have you on the show, and I'm so excited about this index.
Great to be back.
Well, you know what? Let's talk about something. So we've talked today in the show a little bit about the documented results in a 10-year period, and they've gone back and back tested it over a 20-year period, and they've come up with the lowest, the average, and the best, which is outstanding. So let's talk a little bit about how the insurance companies can do that. So if I have $100,000, the lowest 10-year result was close to $200,000.
Just a hair under $200,000.
If I had $100,000 and I had an average result, I'd have about $250,000 in a 10-year period. And if I just hit it at the right time and I had the highest return, that's documented to be around $340,000 on a $100,000 investment.
That's right.
In a 10-year window. How can the insurance companies, Bruce, do this? That is one thing that I want to get across to the investor today. This is how it works. These are real returns. What does the insurance company do with the money that you give them, Bruce?
Right. The insurance companies have to have a way to put your money in a place where it's guaranteed to them so that they can give you a guarantee, rather than have to worry about wiping out their reserves. And they all have cash reserves of varying amounts. So what they'll do is they'll take your money and $100 million of other people's money and go buy high-quality corporate bonds for the most part that guarantee them 4 to 5%, probably more in many cases, interest. And then the insurance company takes the interest only, not your principal.
The interest only.
And goes out and buys options on these various indexes. And if they guess right, they make just incredible money, 30, 40% a year, sometimes more. And they're able to pay these, especially on our monthly sum cap rates, they can pay 2.5%, 2.7% per month because they're making a little bit more than that in most cases. And that's how they're able to do that.
All right, so let me just back that up. So the insurance companies they take my money and they put it in bonds.
Correct.
So they know what the interest rate is that they're going to receive off the bonds.
They know exactly what the money is they're going to receive, so they then can take that money and do other things.
Right. So then they go into the futures market and buy an option.
Right.
So if the market goes up, you make money.
Yep.
But if the market goes down, what happens?
You still make your guaranteed 4%.
There you go. Well, and the other thing, too, to consider is that the reason why your principal is guaranteed is they're only using the interest off of the bonds to purchase the option for you. Then they do it again the following year. So if you're a bond buyer, why would you individually buy bonds? Because you're only going to get the yield off the bond today, but you can't take that money, the yield,
you're
and
only going to get the coupon rate, which is, even savings bonds now don't pay very much. But I've seen people come in with bonds that they've been holding for 20, 30 years, and they were only paying 6 or 7%.
But if you're going to go out and get a great bond right now, you're still going to have to go out 20 or 30 years to get that interest rate, which people don't understand. So then you can't leverage that interest to go into the futures market because you can only do this if you have $100 million.
Well, in most cases, especially if it's savings bonds, you're not getting that interest annually. You're buying the bond at a discount, and then at a certain time in the future, typically 7 years or more, then you cash that thing in, then you get paid.
So one of the things I love about the fixed index annuities, and especially working with this particular real estate index, and we also work with the S&P, the NASDAQ, the FTSE, and all of them, is that when you can really, if you go on, if you're sitting at home today, not if you're driving, but if you're at home today, just write out the numbers 1 through 10 on a legal pad, like year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, okay? They take the interest off the bonds the first year. They go into the futures market. If you make money the first year, you have money.
That's right.
It's there. The second year, they take the interest off the bonds, go into the futures market, and if the market goes down, your principal's guaranteed because it wasn't your money they put in the market.
Well, and it's a new principal because you add to it what you made year one.
So
it becomes new principal.
New principal. But the thing for me is that people need to understand every 12 months, they do this same exact strategy.
That's right.
So the reason why your principal's not at risk is because your principal is in the bonds.
That's right.
It's only the interest that they're able to take and go into the futures market that's at risk.
That's
right. So the risk is if the market goes up, you make a lot of money. If the market goes down,
you make a little bit.
A little bit. So that's why we're trying to tell you today, this is how the insurance companies do it. So these rates of returns when you, and it's really easy for us because on a pad of paper, we can just show you exactly how it works.
And use your exact numbers.
Right. So the beauty of it is that there's some great opportunities right now with this Dow Jones Real Estate Index. It's an uncapped strategy, 5-year lock. There's a spread of 1.9. What do I mean by that? 1.9 annualized over 10 years. So the insurance company keeps the first 1.9, and you get everything over that uncapped. That's the reason why if you have 100,000, Bruce, the lowest result returns would have returned you close to 200,000.
Yep.
And what are the other numbers?
The average return was your 100 turned into almost 250, and the highest return during that time period was your 100,000 would have turned into about 340,000.
Yes, I mean, there's some great opportunities right now if you really understand how the indexes work and how the real estate market is really hot, but you're not taking the risk with your own money.
That's right.
And your principal is guaranteed. Give us a call today. The appointment is free, 972-473-4700. That's 972-473-4700. And this is a non-correlated asset to the stock market. And it also has a gold index that's also available to you as well. So in times like this, which I love the S&P 500, I love working with those indexes, Bruce, because when you understand the power of if the market comes down, if you, in 2008, if you had $100,000 and in 2009 the market tanked, you still have $100,000.
That's right.
So then when the market turns around and comes up,
You're using all your
of your money.
You get to ratchet up with all your money. You don't have any loss. You never lose ground, so you never have to make up lost ground.
right? But the thing is that you never lose ground, but you have all the money. So then when the market spikes up, you're
That's
making
right.
it with all of your money. You're
That's
not having
exactly
to make
right.
up for losses.
There's nothing to make up. It's a real gain rather than an unrealized gain.
So this just kind of is really reminiscent of the early 2000s and 08 and 09. But
Well-
if you work with somebody that has options that are available to you that are not correlated to the market, that give you options to make money even in bad markets, what's the harm in setting up an appointment to come in and visit with us? Because
That's
we can
exactly
show
right.
you how that would work for you today. Remember, the appointment is free. We have offices in Fort Worth, Dallas, Waco, and Austin. If you'd like to schedule a free appointment today, give us a call, 972-473-4700. That's 972-473-4700.
Yeah, if you're in a stock market right now, valuations right now are about 150% above the pre-bubble norm. And now the last 3 times there was this kind of a bubble, and everybody remembers 08, everybody remembers 2001. We're 50% above the bubble mark on valuation.
Yeah.
So stocks are way overvalued. There's no way to describe it other than there has to be a correction.
Well, and the other thing is, too, is going back to what you just said, companies are no longer wanting to buy their own shares even. So, I mean, that kind of tells you that things have kind of stalled.
That's a signal right there. That's a big red flag.
Well, and if you take a look at when we were talking earlier at the beginning of the show, what's the risk reward here? The market might go up a little bit more,
Yeah.
but it could go down really quickly. So you got to
this-
make sure you have a position.
Exactly. This
To
is
protect
dropping
yourself.
your anchor so that you don't get dragged down the sinkhole.
Well, I disagree with you a little bit on that, and I'll tell you why. And the strategies that we're working with, you're not going to have a sinkhole.
That's right. There's no way to have a sinkhole. If you're in stocks, when do you get out? A statement I used to use all the time in the days back when I was trading, and that was, how do you know when to catch a falling knife? You don't. You just get out of the way and let it crash. And so if you can get out, the problem is when everybody's trying to get out, there are no buyers.
And that's kind of,
It's scary.
well, and I think we've kind of seen this market kind of stutter, go back a little bit. It's 17,000. That's historic.
It is historic at some historic levels, but every time there's been a correction, we were at a historic level.
Well, and that's the thing that kind of makes me nervous about this market right now for a lot of people, because the challenge is that once, this government's now...
Once it starts to go,
it's going to go
too
quickly.
late.
And then by the time you get your statement, Bruce,
Yeah.
By the time you get your statement, well, I'll just wait, and then people get into the whole, I'm not going to open up the envelope. I don't want to
I was
log
just going to
on.
say that.
Do you remember back in the day we'd have people come in?
You remember a few years ago, people
Wow.
were coming with stacks of statements that were unopened because they were so sickened by what they had lost, they didn't even want to see their statement.
Yeah.
And that's the wrong way to go at it. Let us bring stuff in. Let us look at it. At least get a second opinion.
Well, the other thing too is the fact that if you look at some of the indexes and some of the things that we're working with aren't correlated directly to the stock market.
That's right.
And there's room for growth. And that's really what you need to do. Now that we know and everybody's kind of recovered from 08 and 09, kind of the glory and the euphoria of the market is kind of over. And I think everybody knows that, but they don't know what alternatives there are.
That's
so
right.
take a look at this Dow Jones real estate index. Take a look at the commodity index that we've talked about today. Take a look at cash flow. Take a look at opportunities. We have offices in the Dallas, Fort Worth, and Waco and Austin area. We'd love the opportunity to sit down with you to review your individual personal situation. Everybody's a little bit different. We have lots of different options that we work with. We're just talking about this real estate option because we know we have it right now, but once it's full, it's going to be full. So take advantage of some of the opportunities that exist in this market right now to make some very good returns based upon something other than the stock market. The number to reach us today is 972-473-4700. That's 972-473-4700. I'm Kathy DeWitt Dunn. We'll be right back to wrap up.